Another new year, another set of financial resolutions. But let's be honest, how many of us truly stick to them past February? Most simply repeat the same cycle: ambition, frustration, and ultimately, falling short of our wealth goals. Data shows that nearly 80% of financial resolutions fail by March. This isn't a willpower problem, it's a systemic one. You're likely making the same predictable mistakes, sabotaging your journey to true financial independence. The real issue isn't a lack of desire, but a lack of a robust, automated financial system. Without one, you're constantly fighting against human nature, making impulse decisions that cost you hundreds, even thousands, annually. Mistake number 1: you don't truly know where your money goes. Many high earners in tech or finance still operate without a clear budget, leaving substantial cash flow unaccounted for and squandered on unnoticed expenses. You might think a $15 streaming service or a $20 daily coffee isn't much. But these micro leaks add up. Over a year, that's $180 for streaming and $7,300 for coffee. Imagine that money invested in the S&P 500. Mistake number 2: allowing high-interest debt to compound against you. Credit card balances, personal loans, or even lingering student debt can erode your future wealth faster than any investment return can build it. With average credit card APRA hovering around 25%, carrying a $5,000 balance can cost you over $1,000 in interest annually. That's a minimum of $1,000 you could have contributed to your 401k or invested in high-growth tech stocks. Mistake number 3: neglecting to build a robust emergency fund. Relying solely on your high income or credit lines for unexpected crises leaves you vulnerable. A sudden job loss or medical emergency can quickly derail years of financial progress. Studies show that nearly 60% of Americans cannot cover a $1,000 emergency with savings. This forces them into high-interest debt, creating a vicious cycle. Your financial fortress needs a moat, not just tall walls. Mistake number 4: letting emotions dictate your investment decisions. Chasing the latest crypto craze or meme stock without fundamental analysis is a sure path to capital destruction. Remember the dot-com bubble or recent SPAC busts? During the dot-com bubble, many retail investors lost 70–90% of their capital chasing speculative tech stocks. More recently, some lost fortunes in crypto or meme stocks, proving that emotional investing rarely ends well, regardless of the era. The allure of quick riches is powerful, but Wall Street is littered with the remnants of those who chased it. Smart money understands that patience, discipline, and a data-driven approach consistently outperform emotional gambling. Mistake number 5: procrastinating on your retirement planning. The "I'll start next year" mentality is perhaps the costliest error. Every year you delay contributing to your 401k or Roth IRA is a year of lost compound growth. Consider two investors: one starts at 25, contributing $500/month, the other at 35. Assuming a 7% annual return, the early bird could have nearly $1,200,000 by 65, while the late starter only reaches $570,000. That's a $600,000 difference? These 5 common mistakes are not just bad habits, they are systemic flaws in how we approach money. But here's the good news: you can stop this cycle. It's time to move beyond resolutions and build a financial system that works for you. Moving beyond resolutions, true financial mastery comes from a robust system. It's about establishing repeatable processes, not relying on willpower. Data shows individuals with a defined financial plan are 3 times more likely to feel secure. Your budget isn't a restriction, it's the operating manual for your money. Implement the 50-30/20 rule: 50% needs, 30% wants, 20% savings and debt repayment. This systematic allocation ensures every dollar has a purpose. Automate your savings and investments. Set up direct transfers to your 401k or brokerage account. A consistent $500 monthly investment into an S&P 500 index fund can grow to over $300,000 in 20 years. thanks to compounding. Diversification isn't just a buzzword, it's a systematic approach to risk management. Don't put all your eggs in one basket. A well-diversified portfolio, like an ETF tracking the S&P 500, mitigates specific company risk and smooths returns. Market timing is a fool's errand. A solid financial system focuses on time in the market, not timing the market. Historically, the S&P 500 has averaged over 10% annual returns over decades, rewarding patience, not speculation. Even the best system needs maintenance. Rebalancing your portfolio annually ensures your asset allocation aligns with your risk tolerance. It's a disciplined way to systematically trim winners and add to underperformers, keeping your strategy on track. An emergency fund is your financial system's crucial shock absorber. Unexpected expenses, like a sudden job loss or medical bill, can derail years of progress. Aim for 3-6 months of living expenses saved, shielding your investments. High-interest debt is a leak in your financial system. Systematically tackle it, perhaps using the debt snowball or debt avalanche method. Paying off a 20% APRA credit card is equivalent to a 20% guaranteed return on investment. Optimize your system for tax efficiency. Maximize contributions to tax-advantaged accounts like 401ks and Roth IRAs. These vehicles can save you thousands in taxes over your lifetime, allowing your money to grow largely unburdened. Your financial system must account for human behavior. Emotions like fear and greed often lead to poor decisions. A robust system, with automated rules and clear goals, helps you stay disciplined and avoid costly impulsive actions. Your financial system isn't static, it's an evolving operating system. Continuous learning is vital. Stay informed on market trends, economic shifts, and new investment opportunities. This proactive approach keeps your system optimized for growth. Regularly review your financial system. Quarterly or annually, assess your progress, reevaluate your goals, and adjust your strategy. The market, your life, and your goals will change, and your system must adapt to remain effective. A well-built financial system isn't just for you, it's a foundation for generational wealth. By mastering these principles, you create a legacy, passing down not just assets, but financial intelligence to future generations, securing their freedom. Start now. This isn't just about avoiding mistakes, it's about a complete mindset shift. From reactive panic to proactive planning, from impulsive spending to strategic investing. This is how you transform your financial future. This isn't a quick fix, but a deliberate construction. Think of it like engineering a robust financial architecture. Your system, tailored to your goals, will guide every decision, turning market noise into actionable signals. It's about consistency, not intensity. With this system in place, compounding becomes your silent partner. Imagine the S&P 500's average 10% annual return over decades, not as a gamble, but as the inevitable outcome of disciplined action. Your consistent contributions and reinvestments are the fuel. Yet, markets aren't a straight line. Volatility isn't a bug, it's a feature. Your system, however, transforms market dips into strategic rebalancing opportunities, allowing you to acquire more assets at lower prices. This is where real wealth is forged. So stop chasing fleeting trends. Start building your own financial operating system today. This isn't just about avoiding mistakes, it's about crafting a legacy, ensuring financial freedom, and building generational wealth for years to come. Your future starts now.